Price, that's the number one technical indicator.
You do best by investing for the longer term.
If you can't explain what the business is doing, then that is a huge red flag.
Some technological change is going to put you out of business.
It really is a genuinely extraordinary situation.
Welcome back. I'm Hayden Brain, and you're listening to Opto Sessions, where we interview the top traders and investors from around the world, uncovering their secrets to success. Justin Onuekwusi is head of retail multi-asset funds at Legal & General Investment Management. The Legal & General Group is one of the world's biggest and most successful insurers and asset managers with over £1 trillion in assets. LGIM's multi-asset team manage more than £63 billion, with Justin playing a leading role in the strategic allocation of those funds. Having started out as an analyst with Aon Hewitt in 2003, Justin next worked at Merrill Lynch during the now seminal period between 2007 and 2008, before taking up a role as multi-asset fund manager at Aviva in 2010. And since 2013, Justin has been with LGIM, now heading up the firm's extremely successful retail multi-asset business. I talked to Justin about asset allocation, leveraging his cross-asset expertise to understand where investors should be weighting their portfolios in 2021 and beyond. We discuss his investment philosophy and how LGIM's use of their extensive index offering gives them one of the most successful low-cost fund ranges on the market. Enjoy. Welcome to the podcast, Justin. Great to have you on the show. So firstly, to deal with the important business, I think I saw on Twitter you're a big United fan. So I imagine you enjoyed the game on Sunday.
Oh, yes, I definitely did. It's not every day that you get to beat your main rivals, particularly the way they've been playing over the last few years. So I was absolutely delighted. Yeah,
I can only imagine. Pretty unexpected from a neutral's point of view. I'm an Arsenal fan, and the less said about that, the better. But I can't say I was expecting a Man United win there. So it must have been a great result.
Yeah, Ollie's got this thing, isn't it? His knack of when we have a run of bad results, then he pulls out a couple of good results, and we think we're on cloud nine again, and it all goes wrong again. So there's definitely inconsistency in the team, but the talent is definitely there. So actually, I'm hoping next season we can actually challenge.
Yeah, good. Well, I say good. I mean, I'm hoping you don't challenge, but for your sake, hopefully they do well next season. All right then. Well, important stuff out the way then, and we'll move on to the main body of the interview. So, I wanted to start by speaking about ETFs and sort of low-fee investment vehicles versus managed mutual funds, and then we'll actually take a step back and cover a bit of your background and kind of what you do day to day. But with the rise of passives and low and even no-fee investment vehicles, are you optimistic that investors will continue to turn to managed multi-asset mutual funds?
I think they will. I think that what you're seeing in the managed multi-asset fund space is that more and more managers are actually investing in index funds anyway. So in managed multi-asset fund space, you're seeing costs start to come down there. It was only 10, 15 years ago, you were talking about full-blown multi-manager strategies where essentially most multi-asset fund managers are picking managers from across the board, across the world. But now the managers that are doing very well, including ourselves, use predominantly index funds in their portfolios, and that brings down the overall cost, but still means you can be active in terms of asset allocation, which is the key driver of risk and therefore return in a multi-asset portfolio anyway.
Yeah, okay, that makes a lot of sense. So you mentioned sort of using indexes within the funds to bring down the cost. Is there anything else that you're doing to make sure your funds are priced competitively?
It's something that I am always really concerned about. So if I think about the four main pillars of our strategy, it's diversification, active asset allocation, suitability, and cost effectiveness. And that is not only in the individual building blocks that we use in order to get access to different asset classes, but it's also in things like, thinking about how to transact on the portfolios. When cash flows come into the portfolios, do you buy everything across the board? Do you buy one single asset class? When you want to sell down your more expensive asset classes, such as direct property, for example, do you do that all in one go? Do you phase it over time? Do you use cash flows to to reduce the asset allocation. So costs and fees are really important. They're the only thing you are guaranteed in fund management, that costs will detract from returns year after year after year. So it's so important to manage them no matter what type of strategy you are.
Absolutely. Okay, and actually there's a few points I want to dig into there, particularly around those 4 key pillars that you mentioned. I've highlighted 2 of them further down in the interview. But before we do that, I'm just conscious that not everyone listening in will know you personally. They'll know LGIM, I'm sure, but they won't know you. So let's dig into your background and what you do on a day-to-day basis. So with a quick sort of look at on LinkedIn and a bit of a research before the call, after 4 years as an analyst at Aon Hewitt, you moved to Merrill Lynch during 2007. So I couldn't sort of move us on without realizing that obviously it's a pretty interesting time to join the firm. So firstly, what was it like working just generally in the investment industry during that period?
I think it's pretty scary, actually. I mean, when I first joined Merrill Lynch in 2007, that was April 2007, and it was, everything was pretty positive. Profitability was pretty strong. Working with lots and lots of smart people, and then all of a sudden, it just went horribly wrong. And I was working in the wealth management business, so nothing to do with the investment bank. And then, quarter after quarter, we're just seeing significant write-downs, and these eye-watering numbers in terms of billions and billions of dollars of write-downs. And for somebody who'd been in the industry for 3.5, 4 years, this was just, I'd never seen numbers like this before. I didn't even think numbers like that existed, so it was frightening. The biggest thing that really frightened me was, or the biggest thing I learned from it was that markets can make even the most smartest people humble, because there's lots of smart people within Merrill Lynch. There are lots of smart people that I work with, but ultimately, when you write down your balance sheet to zero, then some of those smart people have to leave. And that was the most frightening thing. Happy to have kept my job over that period where lots of people didn't. But ultimately, I learned that markets can make even the smartest people humble.
Yeah, absolutely. And as you say there, I mean, you kept your job. You were working sort of in the wealth management division, and you were there, I think, till 2010, where in June you joined Aviva as a multi-asset fund manager. Is that right?
Yeah, that's correct. Yeah.
Yeah. So is that the first time you were leading on the management of a fund?
Yeah, it's really interesting. So at Merrill's, what I was actually doing, I was sat in the CIO team, and I was giving advice to the portfolio managers on their asset allocation. So in a way, I was part of a team that was managing the asset allocation anyway. However, I was focused on fund selection rather than the asset allocation. I was in a team managing the asset allocation. So yes, literally, it was the first time I was managing a multi-asset fund. But I would say the skill set that I learned at Merrill's was actually really important and helped me to do that when I got to Aviva.
Yeah, okay. So I see what you mean. The previous role set you up actually quite nicely to lead on the management over at Aviva. Okay, cool. And then I'm interested to know kind of how you directed your career into the multi-asset space. So was that the first time you were working sort of exclusively within a multi-asset team?
Yeah, so it's a good question. So I actually think I always had an interest in asset allocation, and that from even when I was at Aon, I was giving advice to pension schemes and asset allocation. When I moved to Merrill's, effectively, I was part of a team giving asset allocation advice to the discretionary fund managers. So asset allocation was always a part of what I did, and something I was really interested in. So, but yes, it was a natural extension, I suppose, to go from fund research to fund manager. So you're going from essentially one side of the table to the other side of the table. But in a way, I was very lucky, and I always look back in my career and think that just how privileged I have been And I was really privileged to have worked with the head of portfolio construction at Merrill Lynch, because it was him that went to Aviva to set up the multi-asset funds team, and he asked me to come and join him at Aviva Investors to help him do that. One of the things that I always pass on to my mentees is that it's really important that you it's really important that you work hard and you get noticed for your work, because ultimately sponsors come in all shapes and sizes. I would have never have thought 2 years before he left to go and join Aviva that I would be working underneath that head of portfolio construction. But because of the work I did at Merrill's that stood out to him, he called me. I was the first person he called when he went to Aviva.
Yeah, okay, that's really interesting and actually really useful advice for any of us that like myself. I mean, particularly a bit further back in my career. So that's useful. So I think it was then in August 2013 you joined Elgin. But did you go in as head of retail multi-asset, or did you go in another position and kind of progress to that position?
Yeah, so I went as a fund manager. The team was a lot smaller then.
Yeah.
So it would have been a bit strange for me to be the head of retail multi-asset. But since 2013, we've grown the business, the retail multi-asset business, to be from effectively zero to about £10 billion. So then naturally the team's got bigger, and as the team's got bigger, we've had to create hubs, and these hubs, effectively, the people who are at the top of those hubs as fund managers now have head of roles. So we've got head of strategic asset allocation, head of dynamic strategies, and I'm head of retail multi-asset, which essentially means the retail multi-asset funds as a whole typically will sit under my leadership.
Right, got it. Okay, and you mentioned sort of 10 billion there. Is that as part of the 57 billion in multi-asset funds that Elgin have under management? I think I read that number on your website.
Yeah, that's correct. So I sit in a wider team that manages around 57. I think it might be north of 60 billion pounds actually now in multi-asset fund money. It's headed by Emil van den Helligberg, and we're split into economists, strategists, and fund managers. I sit in that fund management team, and I focus on retail investments.
Okay, interesting. So, as we discussed before the call, there's a lot of retail investors listening in, people that are sort of external and outside of the investment management industry. So, if we can give them a sense of what a typical day looks like for you, and I realise that they're going to be pretty diverse and change all the time. But can you give us an idea or a sense of what a typical day looks like?
Yeah, I can. Yeah. So, if I think about my day today, so I got up reasonably early. I got up at 5:30. Did a little bit of reading. I had Pilates at 6 a.m. So one of the things in lockdown is I've been trying to do as much exercise as I can, and I've got a virtual trainer now who helps me on my Pilates. Particularly when you're sitting down so much, you need help with your posture. I then got my kids ready at 7 a.m. Got them ready for school and nursery. Then at 7:30, I started to prepare for a journalist meeting that I had with Reuters. So just reading up on markets, what happened yesterday, which I do anyway, right? So, but you're reading up on markets, what happened yesterday, what are the key points. The ECB, for example, met today. So I read a lot about what we think of the ECB we're going to do. Then we had our morning meeting, where we go around effectively economists and strategists, understand what they think has happened, or what they think has happened yesterday and what they think is going to happen going forward. Did the Reuters meeting, which went reasonably well. Today I actually had a client meeting as well, so with a financial advisor. So I spoke to them about how the funds are doing. I also, before 12 o'clock, we often get cash flows in that we need to invest, and 12 o'clock is essentially the main cutoff point for the funds that I manage. So we try and make sure we allocate all the cash flows before 12 o'clock, liaising with the implementation team. I try to keep between 9 and 12 reasonably free, so I can focus on those cash flows and focus on markets. And then in the afternoon, I liaise with I manage 4 people. So I sat down with one of the people there, did my one-to-one with them, went through their development and how they're getting on. I also researched infrastructure. So I did a bit of infrastructure research this afternoon as well. And then finally, I do some mentoring. So I did a half an hour of mentoring with somebody within LGIM. So yeah, it's pretty diverse there. In between all those gaps, which doesn't seem to be many gaps actually, but in between those gaps, always looking at markets, always reading the news, always trying to anticipate what the impacts of different asset classes has been, different asset class moves has been on the portfolios overall, and really thinking about overall risk.
Yeah. Okay. Interesting. On that infrastructure point, is that because you want to understand that sector more, or like why are you specifically looking at infrastructure?
Yeah. So typically, the way our team works is we've got economists, strategists, and fund managers. Economists effectively, look at things like growth, inflation, interest rates. The baton is then passed on to strategists, who then say, how did those economic variables impact different asset classes? So this is equities or shares, bonds, currencies, and cash. What's the impact of the global economy going to be on those mainly four asset classes? The baton is then passed on to fund managers, who then try and package it together into an overall portfolio that makes sense for clients. So typically, fund managers don't do, or in our team, they don't do a lot of research. But the aim is that every fund manager will do at least some research of some area, and the area that has fallen to me, as well as another fund manager, actually we do it together, is infrastructure. So that's why I continue to look at infrastructure, continue to monitor infrastructure, to really help out the strategists in terms of their research.
Yeah. Okay. And are you looking at that from a sort of top-down sector level view? Are you coming at it from a bottom-up sort of stock picking view? Like, how does that work?
Yeah. So typically it is from a top-down perspective. So the main areas: airports, railways, toll roads, pipelines, energy pipelines, and utilities. So we'll look at all of those areas and really try and assess, are they correctly valued? What's the sentiment in those areas? What's the momentum in those areas? What's the impacts of interest rates? What's the impact of equity movements on those areas? And we try and formulate all of that into an overall view of infrastructure as a whole.
Okay, cool. Yeah, got it. All right. Well, I want to ask you about one more sort of aspect of your role and what you do day to day before we move on to current markets. So you co-chair the Legal and General Inclusion Team, chair the Investment Diversity Working Group, as well as being on the Diversity and Inclusion Team at your parent company, Legal and General. So can you just talk to us about kind of the work that you do as part of these organizations? So what does all of that mean?
Yeah, so I was thinking about this the other day a lot. Within the investment field, I want Elgin to be a disruptor. I want Elgin to be really create real change and improve client outcomes in investment space. And actually that extrapolates outside of investment as well. That I want to work for a business and work for an industry that is representative of wider society. And that is something that I'm really passionate about. Being a Black man who was brought up in not the most affluent area in Manchester, single parent household, I've seen just how hard it is for certain people to get into an industry like we work in. So what I want to try and do is to create a level playing field for all, so that we can truly say we're an inclusive industry, but actually even further than that, we can truly say we're an inclusive country, because societal change goes beyond the asset management industry, goes beyond LGIM. Actually, it's a societal problem. So I do think that or one thing I'm really passionate about is creating that true representation and an equal playing field for all.
No, absolutely. I mean, you've worked in the city. Obviously, we're all sort of working from home at the moment, as I imagine you are as well. But you've worked in the city, in inverted commas, for over 15 years. Must be since sort of 2003, I suppose, when you joined Aon Hewitt. So where are we on that journey in terms of getting to a properly inclusive industry?
I think there's a long way to go. I think we've made massive strides in the last few years. The diversity project has done a great job in ensuring that companies look at this as an industry level rather than in silos, looking at their individual business. I think that's the way to create societal change, is for the whole of society to look at it. So to look at it at an industry level is obviously a lot more powerful than looking at it at company level. But, you look at the report from New Financial in 2017, which said there were 12 black fund managers in the whole of the city out of thousands. I mean, that is a pretty sickening statistic. You look at the lack of women fund managers in the asset management industry. You look at the gender pay gap, which has actually got wider over the last few years in the asset management industry. And it says that we've still got a lot of work to do. On the positives, we definitely have seen since 2017 greater representation of ethnic minorities, of women in the industry. But clearly, we started from a very low base. So there's still a lot more work to do, which, going back to your last question, that's why I co-chair the JICS, which is the Legal and General Inclusion team. It's why I try and drive greater diversity inclusion, both within LGIM, but also within the industry as a whole, being part of the diversity projects and a co-founder of a movement called Talk About Black.
Okay. Well, actually, that Talk About Black movement, I saw that on your Twitter account, I think it was. If there's anything there, because it's such a sort of important, relevant topic for everyone listening, and actually, to be honest, we could dedicate a whole entire episode and more to that conversation. But we've got a lot more questions to get through, so I want to move us on to those. But actually, just to talk about that movement there, the one that I saw on your Twitter feed, is there any sort of information that our readers can go and sort of find out more stuff that we won't get to in today's conversation?
Yeah, I just followed the handle on Twitter. It's just hashtag Talk About Black, and on LinkedIn. And the idea is just that we're trying to create greater representation across the corporate sphere by simply creating a platform to talk about ethnicity and to talk about race, which, before 2020 simply wasn't really spoken about at all.
Okay, great. Yeah, that's really interesting. We'll put that just in the episode description, just so people remember that. Okay, great. Well, let's move on to current markets then. You said you've talked to Reuters a little bit about this today, so I hope we won't go over too much sort of common ground. On Opto, we tend to focus, or we do exclusively focus on stock markets. I haven't limited our conversation to just that, but there will be sort of a bit of a tilt towards equities in the next few questions. They performed extremely well last year. I mean, if you look at US equities, for example, they massively outperformed a lot of asset classes, aside from your sort of precious metals like gold and silver and things like that. To what extent do you see that continuing in 2021, now that an end to sort of pandemic-induced lockdowns is in sight?
If you think about what really drives equities as a whole, I think there's really three things: the economic cycle, valuations, and systemic risks. So if you think about the economic cycle, we are in the early cycle phase, right? We are at the stage where we're coming out of recession. And typically that's the best time to invest in equities, right? That's the best time. Early cycle is the best time to invest in equities. So that's a big positive. In addition to that, you've got a huge amount of fiscal injections, so tax cuts and stimulus checks coming through the post for people. So people are going to have additional income. And then on top of that, then you've got central banks keeping interest rates, or trying to keep interest rates as low as possible. So fiscal policy, so stimulative fiscal policy, central banks being accommodative, and the fact we're early cycle is all a huge positive for equity markets. Then you look at valuations. What is the price of equities? What is the price of shares? And actually, there are parts of the market that do look expensive. No doubt about that whatsoever. But then you look at, as a multi-asset investor, I've got to invest somewhere, right? You look at equities relative to bonds, and equities actually look reasonably okay relative to the expensive bonds, right? So then that tilts you towards equities again. Then you look at systemic risks, and clearly we've got the pandemic, but it does look like, with the vaccine rollout, we're seeing a lot more positive news that economies are going to reopen, which is a huge, huge positive. The one underpriced risk in the market, I think, is the China-US relationship. I do think that a lot of investors think that given we've got a new administration in the US, we're going to see a more conducive relationship with China. However, it's clear, at least from the first few days, first few months, few weeks of Biden's administration, that you're going to see a hard line to China also. So I do think that market risk is underpriced. We did see in 2018, 2018, just what impacts that China-US relationship can have on markets. So, that is the one risk that I'm worried about. But overall, positive from an economic perspective, reasonably positive for valuations, especially when you look relative to bonds. And then from a systemic risk perspective, okay, there's one risk that's underpriced, but actually there's not that many risks that we see on the horizon that could really derail the equity markets. So therefore, we're positive. We're positive on equities overall. The last point you mentioned on US equities, I do think this is really important. If you are an index investor in US equities, your US equity position is a lot more risky than it was 5-10 years ago. Why? Because the level of stock concentration in that index is a lot higher. What do I mean by that? Now you have 5 stocks making up over 20% of the S&P 500, which is 500 stocks. So you think you're diversifying over 500 stocks, but actually you're getting exposure to 5 stocks making 20% of that index. So, and they've grown over time. It's the tech stocks, right? The tech stocks that have done so well. So Facebook, Google, Netflix, Amazon, Alphabet, et cetera, they're driving the overall risk now of US equities. So by definition, your US equity, your US share position, your US equity position is going to be more risky than it was 5-10 years ago. So it's so important, I think, to be global, to spread your risk over lots of different regions, even if you're positive on technology. Because, even if you're positive on technology, what you don't want to do is hold all your assets in so few names.
Yeah, that's interesting because, a lot of people listening in will be exposed to sort of, your tops of US indices, the S&P 500, for example, and therefore they're top heavy and have been looking top heavy for a while now. It feels as if the market's conducive to actually make them kind of become increasingly more top heavy, if that's even possible. You mentioned there that sort of there's 5 names that are leading the way. I don't see that slowing down. What's your take on that?
Yeah, so I just think that investors are or have a concentration conundrum. We know that over time, over the medium term, diversification is the only free lunch you get in investing. Spreading your risk over different asset classes will smooth out your returns over time. If something is more risky today than it was 5-10 years ago, by definition, if your risk appetite hasn't changed, you should be holding less. So even if you like tech, what we do within our portfolios, for example, we actually like tech, right? We like technology, but we're not willing to hold such a concentrated position. So we reduce our overall technology exposure in those big names and buy a diversified basket of tech names, which is less concentrated. So if you ask me over the next 5-10 years, do I think those 5 names will outperform a basket of diversified stocks? I'd say I don't know. But what I do know, or what I can say with some confidence, is that that basket will have a lower level of risk than those 5 stocks. I think that's the most important thing. This isn't a return argument. This is a risk argument.
We hope you're enjoying the episode. For interviews like this every Thursday, subscribe wherever you get your podcasts. And while you're there, make sure you give us a star rating and leave guest suggestions along with any other feedback in the review section. Now, back to the show.
Yeah, okay, absolutely. I mean, we've talked about the outperformance of equities there, and kind of if we do, I guess, return to the return argument and have that conversation. I mean, if we use your comparison between stocks and bonds, so the S&P 500 climbed 16.26% last year versus the top sort of bond asset class, US corporate bonds, returning 9.7%. So obviously there's a stark difference there. So what, as a multi-asset fund manager, do you do when one asset class is significantly or so significantly outperforming the other?
So again, I think you've got to look at it in terms of the amount of risk you're taking. So there was a point, for example, at the end of March in 2020, where corporate bonds looked really attractive. So, spreads, the level of corporate bonds sold off so much that sold off to the same level that you saw in the global financial crisis in 2008. This is a once in a lifetime opportunity, actually twice in a lifetime, because it's happened within 15 years of each other. So that was the time to really load up on corporate bonds and on high yield bonds, and that's exactly what we did. Then credit spreads, then corporate bonds got really expensive, right? They then performed really well. And the spread you were getting on corporate bonds versus cash, the yield you were getting on corporate bonds versus cash fell to, again, pretty low levels. So that was a time then to direct money out of credit and into equities. So equities, clearly will perform better in an up market. Yeah. And that's what you saw from the 23rd of March, 2020. But I'm telling you, on the 19th of February to the 23rd of March, equities were down about 40%, and corporate bonds weren't down that much. So, I do think taking into account the overall risk of the asset classes is really important. And that's really my job, to try and manage dynamically between those asset classes to get the best return for clients over time with the least volatile performance.
Yeah, okay, absolutely. I mean, and key to all of this, if we turn our minds to interest rates, I mean, that's sort of central to the conversation we're having. And in equities, I suppose, well, people are starting to talk about reflation. They're starting to talk about actually a rotation into value stocks away from the sort of growth phase that we've had over the last few years. What's your take on that?
So I think that if we get true reopening of our economies, then you will get some bounce back from some of these value stocks. I'm thinking stocks like energy, which you've already seen rally, banks, which you've already seen start to rally.
Yeah,
I think you will get a bounce back from traditional value. The question is, how long will it last? And the answer is, we haven't really seen, if you look back in history, we haven't really seen this dynamic before, where you've essentially had checks given out to people in the post, and what they've done with those checks is save them, right? So at the moment, you've got the largest savings rate that I ever remember in my lifetime anyway. Almost 10% of GDP is in savings. So there's a lot of pent-up demand that we think in the next quarter, the next 2 quarters, is going to be spent as the economies, and it's the US data that I was referring to, as economies start to reopen. And that will have a massive impact on, I think, growth. And I think you'll see pretty much, you should see a growth boom, actually. The big question is, what impact does that have on inflation?
Yeah.
And I think we've got to be humble here and say, we actually don't know. We don't know, because the market has been wrong on inflation since 2013, right? Or even before. I was looking at data just the other day. Since 2013, the market has underestimated inflation by a level of 8%. So, they've been widely incorrect in terms of their assumption of where inflation is going to be. So I think we've got to be humble, and we've got to say that actually, unless we've changed inflation regime, which we don't know, until after the event. But unless we change the inflation regime, you probably wouldn't expect there to be a significant amount of long-term inflation. But have we changed inflation regime? Well, I tell you what, a 10% 10% in savings being pushed into the economy may have a significant lasting impact that we simply haven't experienced before.
Yeah. Okay. So broadly speaking, then you share sort of Yellen's optimism that there's going to be a strong economic recovery as a result of this stimulus package.
I think there will be. I think there will be a strong economic recovery. It all depends on also the economy's reopening and the efficacy of the vaccines. But early days is showing us. If you look at the kind of Israel, you look at the impact of just having the first jab of the two jabs that are being distributed by Pfizer. The early days are showing us that actually economies look like they can reopen and look like they can recover. And actually the spread of the virus, once you've had the first jab, is actually pretty positive. So I would, at this moment in time, be positive on the overall economy. Although I would reserve the right to change my mind if we see the rise of these new variants that are immune to the vaccine, which is a possibility. And I think we have to factor that in.
Yeah. Okay. So if we try and sort of distill that, we've sort of set the context. I guess we've gone around the different asset classes. We haven't touched on commodities, but we've spoken about bonds. We've spoken about equities. Like, if we try and distill all of that and kind of sum up LGIM's asset allocation at the moment, kind of how you're positioning for the current market environment, is there a way you can distill that for our listeners?
Yeah. So positive on equities overall. Within equities, positive on technology, but in a diversified way. Also, we like reopening trades. So these are markets that will do well if the economy reopens. So things like railways, autos, value, the European value stocks.
Yeah.
Negative overall on fixed income, and in particular on credits, so corporate bonds, and then negative overall on UK property within our portfolios.
Great. All right. Well, that's a perfect junction then to move on to multi-asset funds. We've sort of alluded to them. You're head of retail multi-asset funds at LGIM. I want to speak about them explicitly and just talk about the various sort of benefits and what's kind of going on in that space at the moment. So I read, and it was according to Morningstar data, that assets in multi-asset funds and ETFs reached $4 trillion in 2020. So that was up from roughly $1 trillion in 2008. Wow. So that's big growth. I mean, why have multi-asset funds, in your opinion, flourished so prolifically post the financial crisis?
I think that there's a few things, actually. I think the first thing which you can't get away with is performance. So multi-asset funds have pretty much had the perfect environment since 2008, where you've seen equities go up. You've seen the longest bull market in history in equities, the longest positive market in history. But you've also seen bonds do extremely well as well. So almost, the two main asset classes that a multi-asset fund will invest in have posted pretty stellar returns. You could have invested pretty much anything in 2009 and you would have had a return of at least 50%. And that's looking at our entire universe. And actually for US equities, it would be something like 300%. So, if you have that perfect environment for equities and bonds, it's like the multi-asset funds will do well. And we know that investors tend to flock to kind of looking at historical performance overall, this behavioral bias that we see from investors. That's the first thing. The second thing is regulation. Regulation has pushed, I think, advisors to outsource their investment capability to those that are regulated and have expertise in managing assets. And to be frank, the universe has got more complex, right? If you look at the size of the universe nowadays, it's not just UK equities, global equities, and gilts. Now we have hundreds and hundreds of asset classes to invest in. the available universe has expanded significantly. And then linked to that, I think some advisors in particular have just said, look, kind of the regulators pushing us this way, but actually we don't have the investment expertise to do this. So therefore, we're going to outsource that investment expertise and focus on areas that we think we do have expertise in. And this is things like assessing whether you should be in a pension or an ISA, assessing your tax liability and the best way to invest to reduce your tax liability, and thinking about lifetime planning. And I think that is the skill set of the advisor, and the advisor.
Yeah, that's an interesting point, because I guess
the
sort of built-in asset allocation and sort of the built-in expertise and fund management expertise that you get with a multi-asset fund allow the IFA to do what they do best, and then the multi-asset fund is the solution rather than a product, I suppose, if we can characterize it like that, for the end client. And I use that term because I've heard it kind of bandied about by various providers, and I wanted to get your thoughts on that. Like, do LGIM, do you personally see multi-asset funds as more of a holistic solution for the end investor rather than just a product?
Yeah, I do. I think that a key element of a multi-asset fund is effectively a solution in a fund wrapper. So the advisor, when they do the planning with their clients, can take some comfort, particularly if a multi-asset fund is targeting a level of risk. If it's targeting a level of risk, then the advisor then can say, this is the risk it's targeting, so therefore this is its expected return, and over 5, 10, 15, 20 years, and then can do some serious planning, cash flow planning with their clients. So actually the multi-asset fund now is providing that solution, because pretty much it's going to stay within that risk profile. The expected return, you can have more certainty around that.
Yeah, okay. And is it the built-in sort of expertise that allow providers to justify their fees? And I'm certainly not approaching it as they need a justification, but obviously to price a product at any level, you're going to need to be able to justify the expense to the end investor. So is that key to it, that built-in expertise?
Yes, I think so. But let's be honest, I think the asset management industry has charged too much for multi-asset products in the past. And this is why you've seen multi-asset products that hold come down in price consistently since I started in the industry in 2003. And I think that trend is likely to continue as asset managers start to consolidate, as the growth of index funds continues. I think you're going to continue to see this pressure on pricing. And that's definitely the feeling we're getting from clients when we speak to them. So yes, I think the fee of outsourcing is justified. But I do think over time, as you get more scale, I mean, you pointed out here, right? The multi-asset fund industry has gone from 1 trillion to 4 trillion. So clearly, if you go from 1 trillion to 4 trillion, the amount of scale you've got of that 4-fold increase means that your profitability has gone up significantly, and actually you can reduce your costs. So I think you are seeing that, and I think that is justified. And the last point I just mentioned on this, the regulator is all over this, right? The regulator has encouraged managers to reduce their fees. You think about the value for money studies from the FCA. They encourage all managers now for all their strategies to say whether the strategy is value for money. So actually, there is increased scrutiny from the regulator now also on fees.
Yeah, absolutely. We're seeing sort of just transparency on fees and costs to the end investor across the board, and obviously that's something that we're all keen to see. But if we turn our minds to sort of measuring performance, then this is sort of an insight taken from nowhere, other than just sort of me looking at the multi-asset funds without actually any exposure to them myself. But it seems difficult to sort of accurately, I guess, benchmark the funds, because obviously you're cross-asset. What's your take on that? Is actually that a difficult thing to do, or have I kind of got that? Have I got that wrong?
I think it is very difficult to benchmark multi-asset funds. And what tends to happen is then that they get benchmarked against each other. And advisors will look at, okay, I've invested in this one. I've invested in fund A instead of fund B. How has it performed over time? And they use the actual universe or peer groups as a benchmark instead of an official benchmark. And I think overall, that's probably the right thing to do, and to look at a group of peers and say, actually, how have my strategy done relative to that group? Because actually, you're right, that there isn't really a proper benchmark for looking at different multi-asset funds. The one thing that you are seeing, and I mentioned this before, is that you are seeing and you continue to see the volatility managed sector. So these are funds, multi-asset funds that sit within volatility profiles. So what you can do is say, this fund sits in this volatility profile, have all the managers in that volatility profile or that risk profile done, and then look at, and look to see, who's been the winners and who's been the losers within that overall risk profile. But as you know, past performance is no guide for the future either. So I think looking at purely past performance ends up being pretty naive. Yeah.
Okay. Interesting. And I guess we've done a decent job there of covering multi-asset funds and products more broadly. But I want to finish the main body of the interview by discussing LGIM's multi-asset fund range. So you mentioned 4 pillars and ways in which LGIM aim to benefit the investor and reduce costs on their side, and ultimately deliver a good product. I wanted to focus on cost-effective construction first. How do you attempt to limit the costs of building each of your portfolios?
So typically, we invest in index building blocks. So even for our multi-manager proposition, where we invest typically in external strategies, there's a limit to the amount of external strategies we'll invest in, and we'll use index building blocks to effectively bring down the overall cost. LGIM, as you probably know, are the UK's leader in index products. So it means that I've got a wealth of capability to tap into in order to build my multi-asset funds using index and passive strategies, and that brings down the overall cost. And that's something that really attracted me to LGIM in the first place in 2013, knowing that the way the market is moving, it's moving towards more cost-effective strategies. So therefore, why not go to a house which has those cost-effective building blocks?
Yeah, okay, interesting. You've got sort of a perfect and very diverse pool of building blocks to pick from, whereas a lot of other houses don't have that. Interesting.
Exactly. A lot of the houses have to buy it for us.
Yeah. Okay. Cool. And just one of the other sort of pillars that stuck out to me was a long-term perspective. So, well, you describe it as key to the sort of investment philosophy. But long-term, I guess, is subjective to the investor. But typically, kind of what time horizon are we talking about to make sure that impacts positively on the cost?
Okay. So, any asset allocation view in the multi-index funds is typically at least a year, but can last for 5 years. So the views are basically 1 to 5 year views. They take medium-term views and try and look through short-term noise, which means that we're willing to be patient. There may be some positions that don't work out for us immediately, that we're willing to be patient on, wait for them to outperform. So I think that's what really distinguishes some of the strategies that we run in the retail market versus other competitors out there, is that we are willing to take that long-term approach and wait for those positions to really pay off.
Okay. But within that, are you retaining some sort of flexibility and sort of ability to be tactical and allocate tactically, or are you quite sort of rigid in terms of sticking to that at least 1 year time frame?
Well, there are some times where we've had 1 to 5 year time horizons and they're paid off in a few months, right? So then if it pays off in a few months, then you don't keep the position, right? You will sell it. the one thing I would say is that the more volatile the market becomes, the shorter that window becomes. So we'll be bunched towards the 1 year rather than the 5 years. But I'm a true believer that taking a medium-term view for retail clients is the right way to invest their money. And it's the way that I invest my own money as well.
Yeah, no, I completely agree. Okay, well, as part of that range, just one sort of tranche or one stream of funds that stuck out to me as particularly interesting was the multi-index investment funds. So I think there were 7 of them I counted, and each aims to meet a range of client needs. So whether that's growth or income, for example, by offering different levels of equity exposure. Can you describe the objective of these sorts of products for our listeners, particularly because I'm assuming a lot of the listeners won't have come across them?
Yeah, I mean, to be honest, they probably have come across them. They're on all the platforms. But yes. So the Lng Multi-Index Funds, they range from 3. There's 5 growth funds, 3 income funds. There are 3 now ESG variants, which I think is really interesting as the market is becoming more responsible in terms of investing. But also there's 3 for European clients. So there's a significant range of strategies there. They range from low risk to high risk, so you can pick the flavor that you want in terms of overall risk and equity exposure. So the most risky one is multi-index 7, where that holds pretty much close to 100% equities. And the least risky one is multi-index 3, which is essentially about 20% equities. So you've got your flavor, and then obviously between 4 and 6 kind of sit in between that. And what we're trying to do is we're trying to remain inside certain risk parameters, so advisors can take comfort and investors can take comfort that that the spots won't change on the leopard, so to speak. We're dynamic in terms of asset allocation for taking those medium-term 1 to 5 year views. Relative to others in the market, we are diversified. So we spread our risk over lots and lots of different asset classes. And this goes back to this heritage we have at Elgin, meaning we've got lots and lots of different asset classes to choose from, because we've got, the biggest UK-based asset manager means that we've got a wealth of scale. And then we try to be cost effective. And I'll just repeat it again. The only thing you are guaranteed in fund management is that costs will detract from returns year after year after year. So it's so important that you manage them and you manage them effectively. And that is a mantra that I've said many a time and I'll continue to say in the future.
Yeah, they just struck me as interesting because it's quite a good sort of, there's a diverse range of products to suit your risk appetite, which is great. But actually, if I flip it around and sort of try and think about it from your perspective, is that a difficult range to manage and maintain? I mean, because as you say, you've got 7 funds across to cater toward several different types of risk exposure and risk appetite. Is that a difficult range of funds to manage or not?
Well, fund management isn't easy, right? The idea of fund management and trying to stay ahead of the competition, and the competition, are all very smart people. It's actually very difficult, right? It's difficult, and that's why we invest in having a really strong investment team, a really strong investment capability, and that's why I've been now in the industry or in the investment markets, not purely in fund management, but you're talking what's that kind of 18 years now. So that comes with experience of going through, seeing the end of the tech bubble bursting. I've been through the global financial crisis, been through this bear market now. So having that experience is really vital in navigating the volatile markets that come about.
Yeah, absolutely. I think there's a lot of experience in the team as well, isn't there? I think I read multi-asset sort of got, I think a figure that was pulled out was over 35 years worth of experience managing funds. So So yeah, I mean, it's all there in the team. Okay, well, I want to finish the main body of the interview there. We are left with our quickfire question round. So this is a generic list of questions that I send to all guests. It's just a light-hearted way to end the episode, and feel free to answer in as little as one sentence or even one word. So first question, what is the top mistake investors make?
To be too short term.
Yeah, definitely heard that one before. Okay, question 2. Where do you go for investment or economic insights? Do you read specific publishers, for example?
Bloomberg. The early morning read by Deutsche is really interesting. The Bank of America Merrill Lynch RIC report is really interesting. And ultimately, I've got a team working with me of 35 people. So they are the main resource that I use, and they're absolutely brilliant.
Great. Question 3. What is the most memorable moment from your career to date?
I think it's been part of a great team and culture, and actually a business. LGIM has been a real supporter of an inclusive culture and have been a leader in the industry at driving greater diversity and inclusion.
Good. Okay. Yeah, that's certainly come through in this interview. Question 4 then, a top tip for your younger self.
The importance of relationships. Whilst it's important to work hard, actually working hard in your relationships is of equal importance.
Yeah. Okay. And question 5. So this is sort of the Opto question. We aim to speak to the companies, the individuals outperforming traditional or typical benchmark returns, I suppose. So we always ask every guest, what is an investor's best source of alpha?
The best source of outperformance, the best source of alpha to me is to ensure costs don't get out of control. Because as I've stressed in this interview a number of times, they're the only thing that I guarantee to detract from returns year after year after year.
Perfect. All right. Well, that just leaves me to say thank you very much, Justin. It's been great to have you on the podcast.
Thank you very much.
Thanks for listening, everyone. Just a quick note before we sign off. If you're looking for an easily digestible daily update on the markets, this might be of interest. Opto Updates is our short newsletter sent every day during the trading week, giving you a bulleted list of the top 7 stories from the global stock markets. We've done the hard work for you, highlighting relevant opportunities and trends. And in addition, we'll also keep you notified of any new products, stock reports, or webinars from the Opto world. If you're interested, sign up using the link in the show notes. And thanks also to Co-Fruition for consulting on and producing the show. Until next time.